Hello, everybody, and welcome to the Build Weekly Roundup of 2025. We've got a lot of interesting happenings going on in mostly the political space, but that's also then bleeding into what you see in the real economy. So, Matt has put together, I think, some really interesting comparisons and slides to kind of showcase that. But really, I want to start off the week with just this incredible the memeability alone of this photo is off the charts. I've certainly already seen several memes coming out of this one, unrelated to politics. But just the title of today's episode: Rate Shortcut Contractors Inc. Reliable partners on your fiscal expansion project needs for over 100 years. Um, Ultimately, if you haven't seen the video, it's Trump touring the currently under construction Fed building with Powell, and at multiple times quipping about the need for lower rates. Mentioning at one point patting him on the back, saying can't wait for him to lower rates. In this paper that you see here, Trump explains that the Fed project is supposed to be, I believe he said, $3.1 billion, and Powell is basically like, "Where'd you get this number from? Show it to me." And he pulls out this papers, pointing at it's straight out of like a Seinfeld episode or something. I don't know. It's a little bit bizarre, but at the same time, I think kind of showcases. Matt last week mentioned the way we're conducting monetary policy is very different from what we've seen in the past, and this is definitely one of those instances of, trying to trying to push for lower rates in maybe a different way than a lot of people are used to. So Matt, I'm gonna let you take it away from here. Rate shortcut contractors. What are your thoughts on all this?
It's amazing. So you made a good tie in there to Seinfeld, right? It really is hard for me not to see this as like written in by the screenwriters, around the writing table on a given week. And you say like, all right, where do we want the plot to go? Like, end of season or end of a multi-episode plot arc. Where are you trying to get the ultimate destination? And then you write in, you fill in the mile markers on the way to get to that destination. And you just look at these two guys here wearing hard hats, looking like complete buffoons, pretending to be blue collar. White guys in suits pretending to be blue collar is, I don't know, one of the most memeable things you can possibly come up with. But it's just, I don't know, impressive, shocking, all of the above. That this is what the screenwriters are doing right now. It's like, how did we get here, right? Well, we need to see more fiscal expansion, right? And we got the playbook on that. That's signed, sealed, delivered, locked in stone with the one big beautiful bill, right? That um, went into effect on July 4th. Now you're moving on to the next phase of the project management plan, and now you're looking at the financing. If you think about this as like a real estate project, right? Well, OBBB, O triple BA was the blueprints. You got the architects, they designed it, they delivered, approved by the city hall, all of that. Now you got to get the bank financing, and that's where your reliable partner Jerome Powell comes in. So, I mean, it's we live in interesting times, to say the least. We've said
To
this
say the
before. This is
least.
your financing partner today doesn't just put on a suit and get on the press conference. Now, to get the markets to agree with what you want to do, um, you got to give them more. You got to give them Seinfeld type um, memes, partially built for, where society is today, where markets are today, responding, on the internet, on social media in real time. But it's a new era, I guess, as we've said multiple times over the weeks we've been doing this.
Definitely. And so, I think this next slide here that I want to pull up here kind of explains the reason why Trump is pushing so heavily on the rate cuts for a variety of different reasons. But I'm going to transition us here. Matt, maybe kind of walk us through. Matt's put together a comparison of German Bunds, the 10-year comp against the Treasury, 10-year Treasury. So maybe kind of explain what you're seeing here and why did you select the German Bund as well? I'm curious.
Yeah. So in interest rate markets, global debt markets, your dollar denominated debt are competing with other currencies, and of the developed regional economy blocks, you basically got two other competitors in the tier one with the US dollar and US Treasury as its kind of global standard in interest rates. You got the euro and then the yen. Yeah, and we won't talk about that today. But for the euro, placing its debt in the global capital markets, there's no EU, um, federated debt. That structure does not exist yet. Well, it may in the future. That's not where they are right now. So when you look at like their benchmark interest rate, right? You foot to the German Bund, right? And if this is, we're getting into football season for the American watchers. It's our national sport. Um, we do things differently here than the rest of the world. Our football is a different game than what the rest of the world considers football, as everybody knows, right? But you're getting into practice, you're getting into training camp, all of that, and you start doing best on best, right? Where your number one offense goes against number one defense. And that's how you get ready for the season. That's what I'm showing here. Our best on their best, right? From the EU standpoint, their best is the German Bund. So if you're looking at these going into the post 2008 environment, we to set, right now, we've become accustomed to U.S. rates being above the U.S. Treasury rates being above the German bonds, and that's the way it's been essentially for the entirety of our experience since the EU debt crisis that really hit its climax in like 2013-ish. So what we've seen since then, German bonds, the yield wants to suppress. That's due to their banking system primarily having a lot of demand for what they view as their safe haven asset, their highest quality liquid asset (HQLA) for bank reserves and other financial institutions to minimize credit risk. So you've been running a positive spread essentially of the U.S. Treasury versus the German Bund for well over a decade. We're going on 13 years. So if you're looking at interest rate markets, all of that, how do you know? Like if you're the United States and we say Trump and Powell, let's just remove the what's it called, the suspension of disbelief aside. There's no there's no gap between Trump and Powell in reality, right? There may be some on style, right? We all know Trump's personality, um, very flamboyant, off the cuff, all of that. And Jerome Powell's style, very buttoned up, very professional, what have you. They're both Northeast, long-term American families, or they come from said background. So there's a lot of similarity there in terms of social class, all of that. It's all where I see like if there is an actual gap, it's just purely on style and personality. But in the actuality here, we've compared this, what we're seeing here. Cameron, you called it a Seinfeld, episode. It's also, very similar. You've heard people describe it as like a WWE plot point, right? Where it's like, okay, how do we extend the narrative this week? Ultimately, we want a big, massive showdown at, the highlight event, WrestleMania. How do we develop the plot every Monday night to get there? That's kind of what I view this whole Trump versus Powell skirmish. Whether it's just beating him up in the media, patting him on the back yesterday at the on-site construction tour. It's all just it's acting for the camera, right? And ultimately, what you want to get, we know that rates are going to come lower on the front end. That's what this inversion in the yield curve has been showing us for 3 years now. When we say inverted, right? Short-term rates, overnight financing rates like SOFR, Fed funds, et cetera, your T-bills, those are all higher than your coupon bonds with longer dated maturities. Now, we've seen that inversion come out. If you look at like short-term rates versus 30-year, that's been uninverted or positively sloped for a long time now. But we still see that inversion on the front end if you look out to 2 to 3 years maturity, or somewhere about 5 to 7 years. You start to see the short-term rates versus those maturities start to flatten or even become positively sloped. But this is where the market's been telling you, we know there's ultimately going to be further rate cuts coming on the front end, and that's just it's not a Jerome Powell, I control this level, I move it. It is true they can cut it, but they can't do what these money markets, like the short term dollar financing markets, overnight funding, all of that. They can't cut them if the overnight markets don't agree, right? If you try to go the opposite way of what the money market wants you to do, you're just going to create some problems for yourself. It's like trying to flush a clogged toilet. Good luck with that. To put back into the construction analogy, right? But if you're looking at interest rates here on the long term to be your guide on where this is heading, I think if you're looking at the 10-year for the U.S. and then the 10-year for the German Bund, what we've been seeing develop in the last couple of years is, and then ultimately going back to 2018, 2019, where we saw the high and the German Bund versus US Treasury spread. It looks like we're getting ready for something, right? And if you think about the backdrop, right, you've seen the push from the EU just based on the NATO discussions, which Trump was kind of incentivizing or spurring this action for the European NATO members to fund more of the defense budget. So you've seen them, break on their hesitance to raise their defense as a share of GDP. That's happening. You saw German government earlier this year remove its debt brake, so they're going to increase debt. What we're watching for on the chart, if you look at the orange line on the top, German Bund yields want to come up, like even from where they are right now at sub 3%. If the German economy wants to run up fiscal expansion, more debt, it's going to be associated with higher interest rates. So that will play out into this US Treasury German 10-year spread. You're basically waiting for the bond market to make its move. If you're Jay Powell and Donald Trump, they've been told by the Wall Street banks, we need more time, wait and see, wait for this thing to develop. So we've got to write a few weeks of filler episodes to ultimately get that outcome we want to happen. That outcome that Trump wants to happen and the US Treasury wants to happen is they want to see rates come in on the short term or short term interest rates. So Fed funds, SOFR, those will eventually come down, but we're waiting for the 10 years, those longer dated maturities, to give the signal that it's an all go.
Got it.
And to get there, it may mean U.S. Treasury rates on the 10-year actually come down as well. That everybody's kind of expecting, hey, if we cut short-term rates in the U.S., we may see like something similar to what we saw last September, where the 30-year starts to sell off. That may happen, or it could be otherwise, just given global capital markets, what's happening in the EU, what's happening in Germany, the fiscal expansion there, the ramp up in defense spending. You may actually see German bond yields up, U.S. Treasuries come down because these large balance sheets, financial institutions, they have to make this compare. It's all relative value. Which currency, which 10-year, what are hedging costs, et cetera. So we basically, why we're seeing all this kind of tomfoolery, from a week to week, these are really just filler episodes. We have to keep the plot running, and that's why you see these just completely ridiculous type of events yesterday, like yesterday's uh, construction site tour, which was entirely a show for the camera.
Right. There's really no reason for him to be there other than camera time. So, yeah, very interesting. And so you have this chart, and I noticed like the last time you see spreads between the 10-year Bund and the 10-year Treasury come down to basically zero is back in 2012. So I'm kind of curious. You mentioned that there's always been this spread, right? And it's very clear on the chart above too. But if they were to converge, yeah, like game plan this out for me, future outlook on that. How does the relative value there play out? If I'm a U.S. bank, let's say, how does that change my decision making on where I might actually park some of my funds, or does
Yeah.
that?
This is like you have a you think about like does anyone have a crystal ball? The answer is no. But the further you go out, the more speculative you have to be on how things can shape up. And so if you condense your timeline in to say like shorter term, you're thinking August or September this year, we should have more clarity on what's likely to materialize, right? It's as far as conditions and um, interest rates, money market, et cetera. No one never knows for sure, right? But you have much more ability to kind of forecast and position yourself, hedge, et cetera. The shorter term you go, the further out you go, the more cone of uncertainty you get into. But for the longer term, I think what you're looking at, all right, if German interest rates want to go up, or we see that spread consolidation because German bond yields up, treasuries. I mean, everybody knows this. It looks like we've exited 40-year plus bull market in US Treasury interest rates. What does that mean? Instead of lower highs and lower lows on yields, you're probably looking for higher highs and higher lows cyclically on interest rates. But if you're looking at any one period on that big primary wave, you aren't crystal clear on, hey, are we in the middle of a bull rally on interest rates amidst a broader backdrop of sell off? Or do we continue to ride that underlying trend of interest rates just are in a broad sell off, expect higher rates? You don't know. It's very hard to see that. But if I had to, you know, picture my story on what I think is the most probable outcome. All right, we do know that EU is going to have to fund more of its defense budget. US just can't. Like, doesn't even matter if it was a 1-2 thing. If we wanted to keep uh, alive this post World War II global security order, bottom line is we can't afford it to the degree we became used to. Our entire lifetimes, our grandparents' entire lifetimes, there's going to have to be a change either way. So, from the EU standpoint, that means fiscal spending up, which means German debt to GDP right now, which is like high 60s, low 70s type of range. That's gonna the burden's gonna be put on them. So their debt to GDP is gonna have to start inching up. And we all know um, kind of real economic growth is a challenge for the developed markets, globally at this point and where we are in the big picture, uh, historical context. Like I'm talking, like if you take like a zoom out 100-year plus views, and so you've got to do a big kind of pivot to get both the U.S., the European economies, other developed markets to um, kind of rediscover that growth engine. It's going to be a big kind of transitional shift. Talked about it a lot before on other episodes. We won't go in much deeper than that. But for Germany or EU specifically, but really led by Germany, kind of like their strongest, right? We talk about football analogy, send their best against our best. all of that kind of implies, all right, if you're going to increase fiscal borrowing, that'll increase nominal growth in your economy, but it's also going to push interest rates up. So you're going to, like, if you think about a capital allocator, all right, if there's more credit creation, more economic growth, and you're going to get higher interest rates, all right, you probably want to tilt towards those markets, or you would consider tilting or allocating into those markets. But I think all else aside, kind of the bigger backdrop, the structural problems in the EU still remain. And just briefly, you're resource poor, right? They don't have the energy, metals, et cetera, raw materials to kind of win that are going to be necessary in the 21st century. We'll get into those in a second. Demographics as well. Every country is experiencing like these aged populations, very heavy burden on their working age populations for like elderly population that needs to be supported. EU is, one of the greatest countries at that. So I think if you're looking at this, I think for the short term, it looks like a positive for EU, but kind of negative outlook for long-term economic growth. And then for the US, you might be kind of the opposite in my perspective. Short-term negative outlook, and then long-term very bullish outlook for a number of reasons. And it's like, how can you square that? Well, think about the US. Like, we're a young civilization, very young country, totally underdeveloped relative to our actual carrying capacity and economic capacity, in my opinion. So there's a lot more growth in front of the US. EU, these cultures, these civilizations have been building since, essentially wave two after, the emergence from Mesopotamia, right? Roman Empire, all of that, Greek, everything. These are long-term, much more developed civilizations. So that's kind of what I view as the big picture trends that we're riding on for, the rest of the outlook for our lives. But for short term, I would look for the convergence here. German yields up because of that fiscal stimulus. US, maybe not negative outlook, but flat. And then the convergence of those two, you're looking for it to materialize in the bond markets.
Got it. And so then that leads us directly into metals. So you touched on metals being a key input, right?
But
For
we didn't talk about the dollar first before we get there.
oh, you're
We'll do
right. Let's
one
talk about the
thought.
dollar.
Give me 1 minute here on the dollar. So um, I think we saw, there's a general kind of market timing indicator. Once you see it start showing up, when I say it, a narrative, start to appear on the front page of like a major magazine like Barron's, The Economist, etc., or New York Times. And in today's era, it's like, all right, if your grandmother's seen the headline or your cab driver and they're talking about it, that means that trend is like ninth inning or done, right? So a big one this year has been dollar had the worst half one of a year since 1973. We talked about this 2 weeks ago when Cameron, you were out on the wedding vacation. Um, but Dave and I talked about this. It was a New York Times headline that everybody, was sharing. It had just entered the zeitgeist. But if you look at the dollar here, you draw that trend line for resistance on the dollar, that downward sloping, and that's an orange. Since July, right? You started the quarter here in Q3 with like over 10 green days in the dollar, positive trading days in a row. We saw a retracement here over the last week, but then on that resistance line that we just broke out of mid-July, we went back, retested it perfectly, right on the money, and bounced. And the green candles have started here the last 2 days. So this would be just Thursday and Friday this week as we're recording. But if you're looking at trend reversals, right, you can zoom out and get more context here for like a multi-year trend. One of the things you're looking for is prior resistance turning into support. And there's actual like trade mechanisms between like actual balance sheets that make this happen. But what you're looking at is basically like, all right, prior support turns into resistance. And when you go through after a breakout, you go back and test that line and bounce off of it. That's a good indicator of a that reversal taking place. So this is something to continue to watch. You know, we talked about a weak dollar. Um, this is actually, if you're the U.S.'s standpoint and you're looking at a economic slowdown, you need financial conditions and key resource imports to be cheap to support your credit system, to support the overall economy. And this is kind of one of the things you're looking at here. We'll talk about copper and oil here in a second, but the dollar itself on the weekend of its trading range, going back to 2008, this is where you want it to be if you're a US policymaker. You want it to be weak. You may not want to see it break and become too weak. So this is kind of like you're in your Goldilocks moment right here for the dollar. This is right where you want to see it. So we'll leave it at that.
Yeah, that makes perfect sense to me. And so then, as we move then to copper, like you were mentioning, you know, I think there's a lot of news as well around price spikes in copper, things like that, related to tariffs potentially, related to other policy related items. So, you know, explain what you're seeing here in the price action for copper.
Yep. So copper earlier this week. So remember prior weeks we saw it rally. This big run up really caught its legs when Trump announced the import tariff on copper. All stages of production, whether it's just raw ore, minerals, all of that, or um, fabricated copper products that have already come out of the smelter, everything was tariffed. So this was really an effort to protect the domestic production industry from resource development, project development at the production stage to smelters, et cetera. So this week we saw kind of the continuation. This was not yet the local top. If you thought that Trump tariff was a sell the news, that's not what we got. Um, Copper continued to hit more all-time highs this week, which in my mind is signaling your problem here. So if you think about kind of the reputation for copper in a global macro sense, how's the nickname Dr. Copper? Not for healthcare or anything like that. It's because it has a PhD in global economics, right? It's your barometer for um, GDP growth, economic activity taking place. So high copper prices in the past is generally a sign of an economy that is working well, running at full speed, all of that. Um, Contrary to that, like depressed copper prices, like we saw in 2008 or 2020, 2016, you can see this on the chart. That's kind of generally compatible or thought to be with a sluggish or under utilized, underclocking global economic growth, right? So the fact that right now, you know, we're seeing copper scream. Um, if you just took that mindset, you would come to the conclusion that hey, economic growth must be just rip roaring. Things are great. I don't know that's actually the case though. I think there's something interesting going on here under the hood. And before I get into that, let's look at copper's cousin, oil, right? So very similar. You know, if you think about economic growth, high oil prices, a lot of factors go into this, but as a measuring stick, right? High oil prices would reflect a strong economy, robust economic demand, people filling up their tanks to go take a vacation, summer season, all of that, or
Shipping.
shipping, or large John Deere, Caterpillar, heavy machinery getting filled up with several gallons of diesel to work on new construction projects, stuff like that. So low copper prices are also, or sorry, low oil prices are also synonymous or correlated with sluggish economic growth. So same thing here, low oil prices in 2008, 2016, 2020. All of those in recent memory are kind of stand out as the low points on economic growth for the U.S. and globally. But right now, in particular, I circled in red, we're getting different signals from copper and oil. Right, copper is saying this economy is roaring. Right, there's so much demand. All engines go. Right, oil is telling you the exact opposite from the look of the charts. Right, you still got this downward trend since Q2 2022 after that first kind of wave of the Ukraine conflict. Oil markets rolled over and they've kind of been in decline ever since. You see that with a lot of blue candles on that downtrend on the quarterly chart we have presented here. So how can those two things be consistent here? Which one's right here? Who's telling you the truth? Is it Dr. Copper, or no one says Dr. Oil, but is it oil, right? And I think that's where you get into, I think something major has changed in the background of like resource markets um, in the last 5 years, especially. I think it's very apparent, but it's been underway since probably 2003. What do I mean? So if you look at both of those two markets, copper and oil, take the ratio of copper divided by oil, you get the copper oil ratio. I've put in white the NBER's recession indicators. We only know these after the fact, right? You get to you get to go look backwards, and in hindsight, you just say, "Hey, the U.S. economy was in a recession here." You don't know that until it's well past that point, right? Um, but if you look at the orange line, I, plotted out the copper oil ratio, and the little blue line horizontal. That's kind of a high water mark for what we've seen. Going back to 1988 is the furthest I could go back and get this data from futures markets on my Bloomberg terminal. But generally, what we saw every recession prior in our lifetimes prior to COVID, right, was a bottoming in the copper to oil ratio, right? What did that mean? Well, we already know, like in the recession, oil prices go down. What actually happened is copper goes down further, right? So they're not necessarily substitute goods, right? Um, copper goes into the house, the wiring, all of that. The oil is moving the dirt to put the house in. But it tells you where was your limiting resource was that the oil, right? The oil held its bid in the downturns, and copper as copper dropped further, right? And up until about 2003 on the chart, I think we were operating in an environment of lower highs, lower lows. But something changed. It became apparent. It was mid 2003, after that 2001 recession, which followed the global recession from the 1998 era Southeast Asian currency crisis. 2003, as we were heading into the housing bubble, 2003, heading into the housing bubble, headed into 2008, we bottomed on the chart of the copper to oil ratio. And since then, it's been higher highs, right? Higher highs and higher lows. And, while we see bottomings kind of consistent with the recession still up until 2008, even 2016, the script flipped with COVID. COVID was like your mid-stage transition event where we crossed over from the old world into the new. What do I mean by that? Well, as everybody knows, like with oil, we had a dynamic where we saw negative oil prices, right, with the shut-ins, with the lockdowns. You didn't see copper sell off in the same degree with that Q2 2020 kind of lockdown induced recession as we saw in oil. And copper, that copper to oil ratio just spikes, which obviously makes sense as that denominator trends to zero for the oil price. Um, but I think that's your signal now when the global economy and the U.S. economy hits its boundary conditions in terms of the actual resources available in the economy, the actual you know the key limiting input is now copper and this electrification trend, which is also showing up in these things like battery metals, rare earths, etc. And we're at the point now where the metals, semiconductors, etc., they've become more important than just that oil to help fill up your diesel powered heavy machinery to move earth, right? So I think if you're looking in the recent rearview mirror here, past that COVID recession line, we saw the local low in copper to oil right about 2022 um, as the commodity cycle rolled over after the Ukraine invasion. But ever since, we've just been going up and to the right, um, which is really telling you, in my opinion, um, the the way that the economy behaves in this new framework, that today's real world, is going to be totally different than whatever rule set we got used to from 1980 to 2020, right? And we can go in there what that means. Hey, if the actual U.S. economy does slow down, at this point, it doesn't necessarily mean that you're going to get input price reductions in your metals like copper, platinum, palladium, et cetera, the rare earths. You may see depressed oil prices. Is that good or bad? Well, think about the background here. In the last 15 years, uh, global energy markets, the fastest growing producer has been US shale, right? Just driven by the hydraulic fracturing technology boom and the supply that has um, kind of unlocked and turned economic that wasn't before. So that's turned the US into an oil and gas producer. What we aren't is a metals and copper producer, right? And that's where this Trump executive order or new tariff specifically targeting copper products in June is really starting to make sense. We produce the thing that we can produce, the oil and gas, that wants to go down still in an economic slowdown, which is still okay, right? You can fill up your car if you're an American, you can take a vacation, whatever. Life gets cheaper somewhat. But the things you actually need to win in the 21st century, bigger electrical grids, more energy or more power capacity to power AI, semiconductors, all of that. Uh, Building out, drone fleets with those rare earth magnets, all of the above. Those things that you actually need to win for your economy in the 21st century, those are what you don't have, right? So I think it'll become clear as the U.S. Now, I think the signal has flipped to, instead of this ratio bottoming in a recession, same thing we talked about where on a trend line, right? Prior resistance turns into support, whatever. It's that same flip, right? At this point now, when your economy is running into its constraint, instead of materializing in a low copper oil ratio, it's like, all right, it's going to flip. You're looking for it to show the other direction around. Copper to oil ratio spikes. That's a bad thing if you're an energy producer like the U.S. is and a copper importer, which makes it just puts into context what we just saw in June and why they're so important. The copper tariffs and then these domestic production deals that you've seen with MP Materials and its counterparties, the Department of Defense and Apple, taking place over the last 4 weeks. So I would say keep riding those trends. But if you're a asset allocator, a wealth manager, I would say it's still very, very early on your typical financial advisor from coming to this realization. Still a lot of, I guess, prior kind of brain wiring, uh, hard coded lessons, rules of thumb, all of that locked in. It's going to take multiple cycles for um, the market, in my opinion, financial markets to really incorporate this into capital allocation and what's going on. But I think your writing is on the wall when you see the U.S. Department of Defense getting involved and financing domestic, metals and resources production. We're in this new world already. It's here.
Yep. And it's just that further reminder of just, I mean, you called it out. It's, if you just sit there and say Dr. Copper and just assume, oh, I see copper spiking, that must mean one thing. I see copper coming down in price, that means a different thing. You're going to end up making the wrong allocation decision. So this is a, I didn't get to, for those watching, Matt and I were not able to discuss this ahead of time. So I'm also hearing it the first time as you. And I think throughout that entire conversation, I was definitely looking at the chart saying, okay, this is a key insight that I think Matt unearthed here. So definitely make sure you pay attention to that. Maybe even rewind the video to rewatch that section.
And it goes into the global trade deals.
Mm-hmm.
So if you think about who are the biggest metals producers? You look at a map, right? They're going to be found in the mountainous regions, right? I'm not a geologist, I don't know this, but just from common sense, I'm thinking, okay, what's actually happening with the mountain formation? You're getting underlying movement in the tectonic plates that is forcing whatever is deep underground, subground, it comes upwards to the surface, and that's where you're likely to find all of those kind of elements coming up to the table, and then they get to the levels where humans can extract them economically. So if you look on a map, right, this is just Captain Obvious. Where are you going to find these metals? Look for mountains, right? So the Andes in South America, I'd be looking in the Rockies here in the Northwest or North America. Talk about the Himalayas, other regions of the world. There's parts of Africa, but it's pretty well covered, like where you're going to find these things. And if you look at supply, this is where China over the last 20 years has gone to all of these places and cut deals with the producers to lock up supply. And then China actually has a lot of the smelter capacity in the world, just being the growing into the world's kind of manufacturing and production engine. And that's where Trump's effect, like tariffs, like we're not going to accept China, smelted copper products anymore. We're gonna own that capacity inside our 50 states borders, and that's where kind of locking up the remaining supply that's out there able to be found. This is the challenge we have ahead of us. So this is really what's going on behind the scenes on kind of the renegotiation of the trade deals. But China is, 10, 20 years ahead of the US on this. And granted, like just with the post World War II environment where the underlying financial system has put the US economy's, domestic production at a disadvantage. You've seen factories close, ship overseas, all of that. I think you've also seen a similar kind of phenomenon playing out in its own domestic resource production. That's changing as well. So you have some low-hanging fruit inside the U.S. itself, and that's kind of the Mountain Pass, production facility that MP Materials is developing. There's more of that within the lower 48 itself. Probably some of Alaska as well. Canada's going to be resource rich, and that's where these trade deals are mission critical. So at this point, you talk about the plot episodes, right? It's like, all right, if you're the show writers, you got to move the plot along. This is not a new season. This is like rip up, the multi-season framework. most shows don't last that long, but think about like a soap opera, like Days of Our Lives. It's been running since 1965. It's probably like every 20, 30 years, you totally get rid of a character that the audience has been following for their entire lives. It's like, all right, we need some new characters here. I view this, it's kind of like that. We need a totally, uh, you know, disruptive plot reset here. Who do we bring in as the character actors to get it done? Well, this really um, kind of opinionated, big personality, main character, energy guy, Donald Trump. Let's put him in. Let's make him run the show. And then you start seeing things like we're living through right now with where we started the show, yesterday's episode, the tour of the Fed construction site, which is, I mean, is it a comedy? Is it a drama? I don't know, but it's pretty ridiculous. I guess we'll just leave it at that. But that's kind of the big picture of what I see happening, and this week is a key development. And I think the big takeaway this week wasn't yesterday's hard hat, photos. I'd say it's the continued run up in copper that's saying, hey, this problem is for real.
100% agree. And with that, I think we'll end today's episode. So thank you everybody for watching. I did want to call out, if you are able to watch this before we go, Matt, myself, and Dave Martin, who I know you've all seen on previous episodes, will be heading down to Portland. So we're going to be attending the Bitcoin is for Everyone conference. If you're able to make it, you're in the area in the Northwest, we'd love to meet you, talk to you, hear your thoughts. So definitely come out and check it out. Portland's a great city. Maybe avoid the downtown area if you're trying to book hotels, but I think it's got a lot to offer, and all the beautiful waterfalls, hikes, etc. If you're able to make it out there too. So thanks again for watching, and we'll see you all next week.